Why you trade the wrong demand zone. If you are marking demand zones correctly in your mind, but price keeps stopping you out, then something is missing in your understanding. Most traders draw a box around a strong candle and call it demand. They wait for price to return and enter immediately. But demand alone is not enough. In this video, I will break everything down step by step. You will understand structure, confirmation, liquidity, and why most demand zones fail before the real move begins. By the end of this video, you will clearly see why you have been trading the wrong demand zone. Let us begin. First, we need to identify the previous swing high. Price was respecting this level multiple times, which tells us that sellers were defending this area. The market was in a controlled movement until this point. Now pay attention to what happens next. Price breaks above the previous high with strong momentum. This is important because a true break of structure is not a weak push. It is a decisive move that clearly closes above the level. When price closes above the previous high, it confirms that buyers have taken control of the market. The previous structure is no longer valid. However, this does not mean we enter immediately. A break of structure only gives us directional bias. It tells us that the market intention has shifted from bearish to bullish. After confirmation, we wait patiently for price to retrace into a valid demand area before looking for an execution. This is how structure builds the foundation of the trade. After the break of structure, do not enter immediately. We wait for price to retrace into a valid demand zone. This demand zone is formed before the strong impulsive move that broke the previous high. It is the area where large buyers previously entered the market. Notice how price left this zone with strong momentum. That aggressive movement tells us there were significant buy orders sitting in this area. When price returns to this level, we are reacting to institutional footprints that are already visible on the chart. However, not every return to demand is valid. We want to see price approach the zone with controlled movement, not panic selling. A clean retracement increases the probability that buyers will defend the level again. The demand zone is not an entry by itself. It is a location of interest. Inside this area, we look for confirmation on a lower time frame before executing the trade. Patience here separates disciplined traders from emotional ones. As price enters the demand zone, we shift to the lower time frame. This is where confirmation begins. On the higher time frame, we already have a bullish break of structure. Now we want to see internal structure shift in the same direction. First, observe how price is moving inside the demand zone. Initially, it may continue forming lower highs and lower lows. This is still short-term selling pressure. Then something changes. Price fails to create a new lower low and instead breaks above a recent internal high. This is the first sign that buyers are stepping in. That break of the internal high is the change of character. It signals that short-term control has shifted from sellers to buyers. This is important because it aligns the lower time frame with the higher time frame bias. Now we have structures supporting our idea. This is where the setup starts becoming valid. From here, we prepare for the inducement phase before execution. Before we continue, if you're getting value from this video, do me a quick favor and hit the like button. It tells YouTube that this content is useful and helps it reach more traders. Also subscribe if you want to see more videos about smart money concepts, liquidity, and real trading setups explained step by step. One more thing, if you're serious about improving your trading, make sure you join my Telegram channel. That's where I share extra charts, market updates, and sometimes setups that I'm watching in real time. The link is in the description if you want to be part of the community. Let's continue. Now we have structures supporting our idea. This is where the setup starts becoming valid. From here, we prepare for the inducement phase before execution. After the change of character on the lower time frame, many traders believe the move has already started. They see the internal structure shift and enter immediately. This is where minor inducement forms. Price often creates a small pullback after breaking the internal high. That pullback forms a short-term low, which appears safe to place stop losses below. Early buyers enter expecting immediate continuation. However, the market does not always move straight from this point. Instead, price may push slightly lower, sweeping the short-term low. This creates liquidity by triggering stop losses from early entries. This sweep is not a sign of weakness. It is a liquidity collection phase. Minor inducement removes impatient traders before the real expansion begins. Understanding this prevents emotional exits and premature entries. Now, after this liquidity is taken, the market prepares for a stronger move. This leads us to the major inducement. After minor inducement removes early entries, the market often creates a deeper liquidity event. This is the major inducement. At this stage, price may move toward a more obvious low inside the demand zone. This low is more visible and attracts more traders. Many place their stop losses below this level because it appears structurally important. The market understands this behavior. Price pushes below that obvious low, sweeping a large pool of liquidity. Stop losses are triggered, breakout sellers may enter, and fear increases. But instead of continuing downward, price quickly reverses. This reversal is the confirmation that the sweep was engineered to collect liquidity, not to continue bearish movement. Major inducement clears out the majority of weak positions before the real expansion. Once this liquidity is taken, the path becomes clearer for price to move toward higher targets. Now the market is prepared for the final execution and continuation toward buy-side liquidity. After major inducement is complete and price begins to move upward, we shift our focus to the target. The market does not move randomly. It moves toward liquidity. Above the current price, we can see previous swing highs. These levels represent buy-side liquidity. Many traders place their stop losses above these highs. Breakout traders also place buy stop orders above these levels, expecting continuation. This creates a pool of liquidity resting above the highs. Smart money understands that liquidity is fuel for expansion. Once price gains momentum after sweeping sell-side liquidity below, it moves upward to attack buy-side liquidity. This is why we target buy-side liquidity instead of exiting randomly. The chart clearly shows where price is likely to deliver. Liquidity above the highs becomes the magnet for the final move. After major inducement is complete and price begins to move upward with strength, we prepare for execution. At this stage, liquidity below has already been taken. The market has removed weak buyers and trap sellers. Structure on the higher time frame is bullish and the lower time frame confirms a shift. Now we look for the final confirmation. Price forms a strong bullish move after sweeping liquidity. Then it creates a small retracement. This retracement forms the final higher low. This is the execution point. Entry is taken after confirmation that buyers are defending the level and structure remains intact. Stop loss is placed below the swept liquidity low, or the setup becomes invalid. The target is clear. Buy-side liquidity resting above. Risk is defined, direction is aligned, liquidity has been cleared. This is structured execution based on market behavior. That is how the entire setup completes from break of structure to liquidity delivery. Now you understand the difference. A real demand zone is not just a box on the chart. It is a level that creates a structural shift, removes liquidity, and confirms buyer control. Thanks for watching. Don't forget to subscribe and hit the notification bell so you don't miss the next video.